What if I told you that being good with money has almost nothing to do with math? No complex formulas. No secret trading strategies. No MBA required. The truth is, the way you think and feel about money matters infinitely more than what you know about it. That's the core idea behind one of the most important books ever written about personal finance, The Psychology of Money by Morgan Housel. Today, we're breaking down every major lesson in this book, chapter by chapter, so you can walk away with a completely new understanding of wealth, greed, and happiness. Let's get into it. Let's start with something that changed how I see people entirely. Have you ever looked at someone's financial decisions and thought, that's insane? Why would they do that? Maybe someone buying lottery tickets every week. Or someone spending thousands on a car they can't afford. Or someone too scared to invest a single dollar. Here's what Morgan Housel wants you to understand. No one is crazy. Every financial decision a person makes perfect sense to them, based on their own unique life experiences. Someone who grew up in poverty during the Great Depression will handle money completely differently than someone who grew up wealthy in the 1990s tech boom. Neither is wrong. They're just shaped by different worlds. A person who's never experienced a stock market crash will be much more comfortable investing aggressively. A person who watched their parents lose everything will hold onto cash for dear life. The lesson: before judging someone's financial behavior, remember, their decisions are a product of their personal history, and yours are too. Understanding why you think the way you do about money is the first step to mastering it. Chapter 2: Luck and Risk. Now here's a chapter that humbled me. Bill Gates went to one of the only high schools in the world that had a computer in 1968. That's not skill, that's luck. His close friend Kent Evans had the same talent, the same drive, the same ambition. He died in a mountaineering accident before ever seeing what he could have become. That's risk. Morgan Housel's point is powerful. Luck and risk are two sides of the same coin, and we almost always underestimate both. We love success stories because they're inspiring. But we rarely ask, how much of this person's success was skill? And how much was being in the right place at the right time? And when we see failure, we blame the person. But sometimes people make every right decision and still fail because of forces completely outside their control. The lesson: be careful who you praise and who you blame, including yourself. When studying financial success, look for broad patterns, not just hero stories. And always leave room for luck in your own plans. Chapter 3: Never Enough. This one might be the most dangerous trap you'll ever fall into. Rajat Gupta grew up orphaned in India, worked his way to becoming CEO of McKinsey, and had a net worth of hundreds of millions of dollars. Then he got involved in insider trading, risking everything he had built for a little more. Why would someone with hundreds of millions risk it all? Because of a disease Housel calls never enough. When your goal is always the next level, you can never win. You make $100,000 and want $1 million. You make $1 million and want $10 million. The goalpost keeps moving, and you keep risking what you already have for what you don't. The most dangerous financial mistake is not knowing when to stop. The lesson: the hardest financial skill is getting the goalpost to stop moving. Enough is not too little. It's actually the most important financial concept there is. Define what enough looks like for you before you have it. Chapter 4: Confounding Compounding. This chapter will make you rethink everything you know about success. Warren Buffett has a net worth of around $100 billion. Here's the wild part: $81.5 billion of that came after his 65th birthday. He didn't become rich because he's the world's greatest investor. He became that rich because he started investing at age 10 and never stopped. His secret isn't returns. His secret is time. Compounding is the process where your money earns returns, and then those returns earn returns, and then those returns earn returns. It snowballs. The problem is that compounding is counterintuitive. It's slow at first, painfully slow, and most people quit before the snowball gets big enough to be impressive. The lesson: you don't need extraordinary returns. You need good enough returns, sustained for an extraordinarily long time. Start early. Stay consistent. Let time do the heavy lifting. Chapter 5: Getting Wealthy versus Staying Wealthy. These are two completely different skills, and most people only practice one. Getting money requires optimism, risk-taking, and bold action. Keeping money requires the opposite: humility, fear, and paranoia. Housel argues that survival is the ultimate financial skill. It's not about making the best returns. It's about not getting wiped out. Think about it this way. A strategy that gives you 10% returns per year for 30 years beats a strategy that gives you 20% for 5 years, then wipes you out completely. Getting wiped out doesn't just cost you money. It costs you time, and time is the ingredient that makes compounding work. Housel introduces the idea of a barbell personality, being optimistic about the long term while being paranoid about the short term. Hope for the best, prepare for the worst. The lesson: once you have something worth keeping, shift your mindset. Stop focusing only on getting more. Start focusing on not losing what you have. Survival first, growth second. Chapter 6: Tails you win. Most of your results will come from a tiny number of decisions. This is a concept from statistics called the tail event. In investing, most stocks underperform. A huge number of investments fail. And yet, a small handful of investments produce massive, extraordinary returns that more than make up for all the failures. Housel points out that even the best investors in the world are wrong a lot of the time. The secret is that when they're right, they're really right. Amazon's success was driven primarily by Amazon Web Services and Prime. Disney's success was driven by a handful of iconic films. Most of everything else, average or forgettable. The lesson: you don't need to be right all the time. You just need to be in the game long enough for your tail events, your big wins, to play out. Don't be so scared of failure that you never position yourself for a massive win. Chapter 7: Freedom. Here's what money is actually for. Research on happiness consistently shows that the number one contributor to happiness is autonomy, the ability to control your own time and decisions. Money's greatest value is not the things it can buy. It's the freedom it provides. The ability to say no to a job you hate, to take a year off, to spend your mornings with your kids, to pursue something meaningful instead of something profitable. Housel argues that the highest form of wealth is waking up every morning and saying, I can do whatever I want today. And here's the painful irony. Many people chase money by sacrificing their freedom, grinding 80-hour weeks, taking on soul-crushing jobs, ignoring family and health. They win money, but they lose the very thing money was supposed to buy them. The lesson: define freedom as your financial goal, not wealth itself. How much freedom does your current financial plan buy you? Start measuring that. Chapter 8: Man in the Car Paradox. This one is quick but cuts deep. When someone drives by in a Ferrari, what do you think? You probably think, wow, that person is successful. But here's the paradox Housel exposes. You're not thinking about the person in the car. You're imagining yourself in the car. Nobody is admiring the driver. They're admiring the idea of being wealthy. This means if you buy an expensive car or house to signal success and earn admiration, it doesn't actually work. People are too busy imagining themselves with your things to admire you. The lesson: spending money to look wealthy is one of the biggest financial traps. True respect comes from character, kindness, and intelligence, not possessions. Chapter 9: Wealth is what you don't see. Real wealth is invisible. The flashy car, the big house, the designer clothes. These aren't signs of wealth. They're signs that someone spent money. Real wealth is the money you didn't spend. It's sitting in investments, savings accounts, and portfolios. It's invisible. This is why we have such a distorted picture of what wealthy people look like. We see spending. We don't see saving. The lesson: stop measuring wealth by what you can see. True financial success is building invisible assets, savings and investments that give you options and security. The less you feel the need to show your wealth, the wealthier you probably are. Chapter 10: Save money. The most unsexy financial advice is also the most powerful. Building wealth has little to do with your income or your investment returns. It has everything to do with your savings rate. A person earning $100,000 and saving 30% will accumulate more wealth than a person earning $200,000 and saving 5%. And here's the thing, you don't need a reason to save. Saving for a specific goal makes sense. But saving beyond your goals gives you something even better: options and flexibility. Life is unpredictable. The person with savings can navigate a crisis, take a career risk, or seize an unexpected opportunity. The person without savings is at the mercy of every curveball. The lesson: lower your ego-driven desires, and your savings rate will follow. You can grow wealth without a high income, but you cannot grow wealth without a high savings rate. Chapter 11. Reasonable, rational. Here's why perfect financial strategies often fail. The mathematically optimal financial strategy is often not the one you'll actually stick to. Housel argues that being reasonable beats being rational in personal finance. Example: holding stocks 100% of the time is mathematically the best long-term strategy. But during a 40% market crash, most people can't hold. They panic. They sell at the worst time. A slightly less optimal strategy that you can actually stick to emotionally will almost always outperform the perfect strategy you abandon during a crisis. The lesson: build a financial plan that fits your personality. A plan you can stick to is worth more than a perfect plan you'll abandon when things get hard. Chapter 12. Surprise. The biggest risk is always the one you didn't see coming. History is full of surprises. Every decade sees events that were unimaginable just 10 years earlier. Housel's point: the most important financial events are always the ones nobody predicted. This means using historical data to plan your financial future is useful, but not enough. History can tell you that surprises happen. Can't tell you what the next surprise will be. The lesson: build financial plans that can survive shocks, not just plans that look good on a spreadsheet. Expect the unexpected. Keep buffers and margin for error in everything you do. Chapter 13. Room for error. The most important financial skill nobody talks about. Margin of error, buffer, safety net. Whatever you call it, this concept is everything. Housel frames it this way: the person who survives long enough eventually wins. If you invest every dollar you have with zero buffer, one bad year can wipe you out before compounding has time to work. The point of a margin of error is not pessimism. It's staying in the game. Think of it like a road trip. You fill your tank full even if you technically have just enough gas to reach your destination. Why? Because you don't account for traffic, detours, unexpected stops. The lesson: whatever your financial plan requires, double it as your safety net. Keep cash reserves. Don't be fully invested in a single outcome. Assume things won't go perfectly because they rarely do. Chapter 14 and 15. You'll change. The person you are today is not who you'll be in 20 years. We're terrible at predicting our future selves. What you want at 25 is very different from what you'll want at 45. Your values change. Your priorities shift. Your definition of enough evolves. This creates a serious financial problem. We make long-term plans based on our current identity, but our future self may be completely different. Housel calls this the end of history illusion. We know we've changed in the past, but somehow believe we won't change in the future. The lesson: build flexibility into your financial plan. Avoid locking yourself into extreme long-term commitments. Accept that your goals will change and let your plan change with them. Sunk cost thinking, staying in a bad decision because you've already invested, is the enemy here. Chapter 16. Nothing's free. Every reward in investing comes with a price. The stock market delivers 10% annual returns over the long term. But the price you pay for that return is volatility, anxiety, and the emotional torture of watching your portfolio drop 30% or 40% during a crash. Most people try to get the reward without paying the price. They try to time the market, hedge everything, pull out at the first sign of trouble. And in doing so, they lose the return. Housel's framing: market volatility is not a fine. It's an entrance fee. You have to decide if the ticket is worth buying. The lesson: every valuable financial outcome has a cost. Identify what that cost is: time, stress, volatility, uncertainty, and decide consciously if you're willing to pay it. If you are, pay it. Don't try to sneak in through the back door. Chapter 17 to 19. The big picture. Let's zoom out and talk about how the world's financial story shapes your personal one. You and me, your personal financial decisions make perfect sense inside your own bubble. But financial products and markets are designed for many different types of investors, and what works for a long-term institutional investor may be terrible advice for you personally. When you see experts giving financial advice, always ask, are they talking to me or to someone else? The seduction of pessimism. Pessimism sounds smart. Optimism sounds naive. But historically, the world has trended upward. GDP grows. Technology improves. Living standards rise. The people who bet against long-term progress have consistently been wrong. Pessimism is loud and urgent. Optimism is quiet and slow. Don't confuse what gets attention with what's actually true. When you'll believe anything, stories are more powerful than statistics. A compelling narrative can make you believe things that data would never support. Markets, economies, and individual financial decisions are all driven by stories people tell themselves. During booms, the story is, this time is different. Prices will only go up. During crashes, the story is, everything is broken and will never recover. Neither is true. The lesson: be aware of the stories you're telling yourself about money, the economy, and the future. Ask, is this a fact or a story that feels like a fact? All right, let's bring this home. Morgan Housel wrote The Psychology of Money not to give you stock tips or budget templates. He wrote it to change the way you think, because your behavior with money will always matter more than your knowledge about money. Here are the 7 lessons to carry with you. 1. No one is crazy. Everyone's financial behavior is shaped by their unique history. Have empathy for others and self-awareness about yourself. 2. Luck and risk are real. Don't give yourself all the credit for success or all the blame for failure. 3. Define enough. The goalpost that never stops moving will ruin you. 4. Compounding rewards patience. Start early, stay long, let time work. 5. Survival is the ultimate skill. Staying in the game beats any fancy strategy. 6. Freedom is the goal. Use money to buy back control of your time. 7. Leave room for error. Things will go wrong. Build buffers. Stay flexible. If this video helped you see money differently, like and subscribe. We break down the world's best books so you can think sharper, live better, and build real wealth. Comment below which lesson hit you the hardest. I'll see you in the next one.